You guys hear me okay? There we go. Good? Okay, we got 4 minutes left, a little bit over 4 minutes before that FOMC rate decision is actually released, and that will tell us if the Federal Reserve plans to pause, raise, or cut interest rates. As of right now, the really two outcomes that they are expecting is a 96.9% probability that the Federal Reserve is going to pause, and a 3.1% probability that the Federal Reserve is going to be cutting interest rates. So what exactly would that mean for the market? I want to remind you, they begin to cut interest rates. That should make it less expensive for people like you and I and businesses to borrow money. Therefore, naturally, spending should increase. And if spending begins to increase, then our economy can grow quicker and faster, causing markets to go higher for longer, traditionally speaking, right? That doesn't mean that that's how the market has to react. That's just traditionally how the market has reacted. With that being said, it's not expected that the Federal Reserve is going to be cutting interest rates until maybe September, so next month. We'll see though. I'm sorry, not next month. That's August. Ricky, I need to learn my months. All right. What's up? What's up? Glad to see that TQQQ is up today. Hope that it goes into new all-time highs. We'll see. I feel like Nasdaq market went up enough already. You think it's going to go up higher? And we still have Meta that's going to be reporting earnings. Let's run a poll. Let's run a poll real quick. How do I do this? Start a poll. Here we go. What are markets going to do? Let's see what you guys think. Am I shorting Nvidia? Heck no. What the heck? When was I holding a swing trade to short Nvidia? If you tuned on into our live trading session today with the LPP team, you would have very clearly heard me say that is Nvidia overbought on the day? No question about it. I don't think anyone can agree or disagree that, yeah, anything that pushes up 10%, 11% within a very short period of time is overbought. Overbought doesn't mean that it has to pull on back. Now, don't get me wrong. I've obviously have taken trades before confirmation. But with that being said, I know Nvidia is a juggernaut of a company. It's the new shiny toy on Wall Street, right? Especially with the way that it's been performing. So I don't have a position at all in it. I can show you here. I have nothing. I'm not long on it. I'm not shorting it. I'm waiting. I'm waiting for market direction to be a little bit more clear. I want this to all have been settled. I want to understand, and I want the market to react to this FOMC rate decision that's going to happen in the next 1 minute. And then I want to have big tech report earnings today with Meta and tomorrow with Amazon and Apple. After that, then we can decide. Okay, we have about 40 seconds left. 40 seconds left. Make sure that you submit what you think is going to happen. For those that are tuning on in for the first time, I hope that I earned your thumbs up. I want to remind you that the report is going to get released, and then 30 minutes after, Jerome Powell is going to go live and begin to answer questions from reporters. So just make sure that you are aware of that there are two different catalysts in the next hour. So best of luck. I wish you guys nothing but the best. Let's see what happens. Here we go. We got NASDAQ market here. And any second now, we have 3, 2, 1. How is the market going to digest that? It's going to be positive or negative. It's not going to surprise us. I mean, it's probably going to be as expected that the Federal Reserve is going to pause. There it goes. Looks like we're seeing some selling pressure, not much. These rate decisions, when they're paused, they're just not much of a surprise, right? Because the Federal Reserve is not cutting, they're not raising. These kind of have been a little bit on the boring side. Who's been here since 2023 when the Federal Reserve was raising all these interest rates? When we would have FOMC rate decisions and the Federal Reserve would raise it 3/4 of a point, or they would raise it half a point. Do you guys remember those? Those were wild times. This is kind of like, am I wrong? Do you guys remember those days? Started trading in January of 2022 during a very bearish year. I'm glad that you brought that up, David, because if you've made it this far, if you started trading in January of 2022, 2022 was a very bearish year. So you got to experience a bear cycle, and then when markets recovered in 2023, you got to experience a bull cycle. And you'll see, right? If you experience both of those cycles, you'll learn a lot that it's not about that you're an amazing investor, but it has a lot to do with timing and what market cycles you are partaking in. Right now, we're kind of in the end, I would say, based off of what we're experiencing, of a bull cycle, right? Markets have been going up since 2023. They've made new all-time highs. They've been going up higher for longer for quite some time. Now, if we do enter this bear cycle, a lot of traders are going to get wiped because they've only succeeded and traded in bull cycles. This is why it's very important to be what do we want to say? Well-conditioned, well-experienced in both of those cycles. And if you see that the market is turning on you, it's not that you have to predict the future. It just means that you reduce position to be able to tolerate the time that it will take for the markets to recover. You blink and there goes your account. Dude, they were crazy times. There were times like, man, I remember like TQs and SQs because we used to pay attention to just those, right? QQQ is a 1-for-1, so it doesn't move too crazy. But if you were to look at something like, we're not going to get that movement today, but it was just wild. It was like right when the FOMC rate decision came out, TQs or SQs were up or down like 5 or 7%. It was just a wild time. There was a time that TQs gapped up like 17%. Think about that. In just like 5 minutes, it gapped up 15% because the market went up so much. But I've also seen it on the opposite side where SQQQ gaps up 10-15% within a very short period of time. And I think that's the beautiful thing about trading is that if you actually give yourself the time that you need to become seasoned, that doesn't mean that you need to be super successful the whole time. It just means give your time to experience these different market cycles. Enjoy the process. If you're in such a rush to try to make money right away, I really don't think that you will last long here, right? The market will humble you very quickly, especially as it transitions from bull cycles to bear cycles. No big movement today until Powell speaks. More patience and waiting. I like that. I like how so many of you guys are speaking about like being patient and staying cash. Maybe it's just me, but it's a concept that we talked a lot about, a few years ago. And I kept trying to preach about like, hey, it's super important to like not always need to be in a position, right? Any open position is a position that's open to risk. And it's really cool to be able to see you guys take initiative and lead by example, right? So I don't know if it's something that you learned from me or you learned from other people, regardless of who it is that you learned it from. I think it's something that every beginner should respect, right? And it's that you don't always need to be in a position. There's something so beautiful about being cash, waiting for an opportunity to present itself, and when all of your criteria is met, then you choose to take a trade, right? Actually having control of the opportunities that you are taking advantage of. Better be a little late than make a mistake. Got Brian the poet out here. It kind of rhymed. It kind of didn't, though. Let's go ahead and just pull it up so we could see it right here. So we could see that we came in at, it should be unchanged. Okay, well, it's saying by the next Fed meeting right now, there's a 9% probability. There it goes, TQQQ trying to break above. Have you ever traded Forex before? I do not. I've nothing against it. I'm not here to speak bad about other markets. I'm not here to speak good about them. All I'm here to remind you is that I don't care if you trade in the stock market, if you choose to trade in the Forex market or crypto. My biggest encouragement is that if you want to be successful in any market, you have to fully obsess about just one. And then once you have that figured out, maybe you can begin to expand, but that's going to take, in my opinion, years. So I don't like the idea of people jumping from Forex to stocks to crypto, and you don't give yourself a chance to succeed in any of the markets, right? Every market's going to have its pros. Every market's going to have its cons. With that being said, do your part in overcoming those challenges and try to actually learn from the mistakes that you make, because every market's challenging. So thanks for taking time to stream, Ricky. Of course, Junior, I appreciate you taking time to tune on in. Thank you. It means a lot. We have NVIDIA still holding high. Look at that. Retesting previous highs here. Do you like TQQQ better than QQQ? I choose to day trade TQQQ because I like the volatility. It also does come at a greater form of risk. So I think that's important to note. Could you make more money with TQQQ? Sure. Just like you could lose more money with TQQQ. So if you're a beginner, learn how to walk before you run, right? If you're learning how to drive a car, is it the best idea to learn how to drive in a 1,000 horsepower Corvette ZR1? Probably not, right? Is it a horrible idea? Like, is it impossible? No, it's not impossible, but it's probably not the best, not the safest, right? It's the same thing. Learn how to walk before you run. Start small. Make a lot of mistakes. But if you start small and you learn from those mistakes, they cost you very little money, right? And I think that's always the encouragement that we have for everyone that joins LPP, is that don't be afraid to make mistakes. And if you're trading with too much money that you are afraid to make mistakes, you're not really giving yourself a chance to learn and to test things, right? Because in any market, in any business, you need to not be afraid to test and challenge yourself and push the limits with different, best practices. That doesn't mean that you have to trade with a lot of money. That means that you can test things in a very calculated way with a small exposure to, that monetary risk. You are at the office, Ricky? I am. Do not come here. You're not welcomed. Just kidding. Yeah, if you guys ever want to come to the office, message me first. If you just show up and you didn't message me, I don't care if you're out of town, I will not let you in. Don't be a weirdo. But yeah, if you actually want to get work done and you're not going to be like weird, I'd love for you to use the office to actually get work done. And it doesn't just have to be trading. If you're a real estate agent, if you have your own business, sure, if we're open and we're here and you messaged me before, I'd be happy to open it up for you. But if you're a freaking weirdo and you just show up here and you just expect to be let in, I'll tell you to kick rocks. Define weird. I'm not gonna. Do you have monitors? We have a few. Yeah, we have monitors here. Shorting NVIDIA equals weird. Oh, I like it. Hey, as long as you guys have a good sense of humor, right? If you get easily offended and you're going to be asking me a gajillion questions when you're here, don't come. I can't wait for the reporters to ask questions. Yeah, for those that are tuning in for the first time, you guys are probably like, what the heck are we waiting for, Ricky? Like, why are you still live? In about 20 minutes, Jerome Powell is going to go live. Jerome Powell is the head of the Federal Reserve. This is where he's going to be giving a quick little summary. It's kind of like a script. He says almost the same thing over and over again. But nonetheless, he says his little script, and then after he begins to answer questions. Traditionally, he's very well spoken. He's very clever. He's not very biased in the way that he speaks, and he's very calculated in the way that he speaks. So you'll learn this about him. Some people like him, some people don't. I think he does a fair job. I like that he's unbiased. He doesn't overstep in sharing too much of his opinion and things that do not concern the Federal Reserve. So with that being said, in about 19 minutes, he's going to be speaking. Is it cool if I continue the live stream to capture at least the part of that? Or do you guys want me to close out the live? You guys let me know. All I ask for you guys to do is we have a little bit over 1,000 of you guys here. Drop a thumbs up and make sure that you guys subscribe to the channel. If you guys haven't done so already, I mean, I greatly appreciate it. Obviously, I'd love to keep you guys up to date with everything stock market related. And all I ask you to do is drop a thumbs up and subscribe. You guys remember the baddie? Oh, ish. That's the thing. That's like, you'll see. Yeah. No, these different reporters, because no. Oh, there's none right now. So you'll see once we are live. We have a handful of these guys in here that anytime a girl will pop up once they begin speaking. There's nothing right now, but
That'll be in the chat.
Yeah, once they do begin speaking, you should see the chat. The chat's unhinged.
So are they here to trade or check out?
Dude, I don't know. I don't know if they're even here to. I really don't even think they know what the FOMC meeting is.
It's their secret way so the girls don't catch them. I'm just watching Rick.
Yeah, they always say, I got to ask her a question. Do you think that $40K as a 21-year-old is enough to buy and put down as a down payment for an investment property? That's way more than enough. I think it all has to do with that. That can be a question for another video, but I know that you need 20% down traditionally. There's a lot of untraditional ways on how you can actually purchase an investment property. If you're in Arizona and you find a house that you think would be a good flip, but maybe you don't have the capital to actually do it, I would be happy to pay for it and we can split the profits. So I've said that so many times, especially if you guys follow me on Instagram. We try to buy 1 to 2 properties a month that we purchase with the intention to flip, to resell. And if you don't have the capital, but you have, the deals and you're really good at finding deals either through friends or family or your followers or door knocking, whatever the case might be, if the numbers make sense and there's money to be made and you present it to me, I could pay you a finder's fee of a few $1,000s, or we could just split the profits, just depending on how good the margin is. I mean, I'm open to the conversation. I'm not here to help you find the deal and then still split it with you. If you find the deal to me, right, we have to complement one another. So if I have the money and I have the contractors that are gonna, take care of the entire project, but you found the deal, that makes sense. If I'm gonna have to help you find the deal, and then on top of that, I do all of the work on the back end, that's not necessarily what I want. So if you know someone interested in selling in Arizona, and they want a cash buyer, we could avoid all fees, just go directly to title, and we can close as quick as 10 days. But yeah, you can message me on Instagram. It should be linked in the description of this video if you guys don't follow me on Instagram already. My name is Ricky Gutierrez with 2 Z's. I'm verified on Instagram, and just a quick little heads up, I only have one Instagram account and I'm verified. All the other accounts that pretend to be me, I can promise you, are fake. I will never message you. I will never message you first. So it doesn't matter on what platform it is, if it's on Discord or email or Facebook or WhatsApp or YouTube, I will never message you first. If you don't message me, I won't message you. So, Ricky, my new cash buyer in Arizona. Yeah, if you find me a deal and someone needs to get rid of a property quick and you need a cash buyer, I'll do it. You can put me in as your contact, as what you can call me, whatever it is that you want. Cash buyer Rick, whatever it is that suits you. Do you only buy in Arizona? Yes. So mainly only in Arizona, unless the deal is extremely worth it, and maybe it's in California, I could consider it. But remember, we're just 2 guys. It's myself and Nick. We oversee. I'm just the investor. Nick oversees all the contractors. And yeah, so we like to keep it small. It allows us to feel in control of the projects that we take on, and it would be a great learning experience if you're wanting to get started in this. Not only could you make money by partnering up with us, but also you can shadow myself and Nick, mainly Nick. Bank of Ricky. Yeah, you can call me whatever you want. Gonna send you 50 Zillow links. What's up, brother? Yeah, definitely not. If you start sending me properties that are listed on market that you want me to reach out to them just to see if we could close it, I'm gonna tell you to kick rocks and I'll block you on social media. I'm live on YouTube. You can sit over here. I want to get into flip so bad. Find a deal, and I'll put up the capital. Please don't buy properties in California. You guys cracked me up, man.
I like that guy.
Yeah, I'll buy anything as long as the numbers make sense. I think that's a fair play. Do you flip houses in Hawaii? I would buy a house in Hawaii, honestly. I'd buy it and keep it as a rental. If it was a good deal, yeah, send it to me over Instagram. Don't send me properties that are posted on market for 60 days that you think are good deals. If other people haven't purchased it within the first 10 days, I can promise you it's not a good deal. Yeah. Microsoft. What do you think about Microsoft stock? Has it fully recovered from yesterday's sell-off? Nearly. I'm impressed. We talked about it yesterday because we actually went live yesterday during Microsoft's earnings. And Microsoft's earnings were not bad. They were actually better than what was expected. It was just the expectation of the return that they had with their AI network and their Azure. The growth is a little bit slower than what they expected, especially with how heavy it is that they were investing into it. So because of that, it's just going to take a little bit more time. And I think it just lowered expectation. There was a lot of hype. That doesn't surprise me at all. So do I think Microsoft is a solid company? Of course. I mean, look at this. When in doubt, zoom out. Look at this. Looking at this on the week chart, higher highs, higher lows. It's extremely bullish. It pulled back a little bit, and we'll see. We'll see as Meta reports earnings today, as Amazon and Apple report earnings tomorrow, if markets begin to recover or if markets continue to drop. Why overcomplicate it? Like, there's so much money to be made as long as we focus on one thing, and that is market direction. If markets sell off, we can take it day by day and short the market day by day. We don't have to swing trade that. And when the markets begin to find its support and begin to recover, we can buy into the dip and make money on a swing trade or on investment on the way up, right? That's the beautiful thing about trading and knowing when to swing trade, is knowing when to step on the gas and when to stay light, when to day trade or when to swing trade. So yeah, that's one that I wanted to learn more about. Oh, CHPT. Sorry, I got that confused. CHPT is not Yeah, this is ChargePoint. ChargePoint, wasn't there like a YouTuber that promoted this? I heard so much about it. Like I was getting so many questions about ChargePoint that I was so confused. I'm like, why are so many people invested in ChargePoint? Um, I don't care what anyone's expectation or their forecast is. This is super shitty. I mean, look at its performance. Look at the price action. It speaks for itself. If you were to show me this, why in heck would I want to buy into it? There's no indication of growth. I don't care about what the forecast or what they're saying it's going to do. It's not doing it. Lower highs, lower lows, extremely bearish. I'd completely stay away. Until direction begins to change, then maybe then. As of right now, I am saving money by not being invested in ChargePoint. I think that's the best way to put it. If you're missing out by not being invested, that's a different story. This is not the case. Extremely bearish, lower highs, lower lows. The cheap can get cheaper. And I don't know why people listen to try to copy other people's investments, especially on YouTube, right? There's nothing wrong with sharing ideas, but you should never make a sole trade or investment decision based off of someone else. We all see value in different ways. And that's been one of my biggest things. I was actually having a conversation with someone yesterday over Instagram. This kid actually got offended. I actually don't even know if he's watching this. He was a young kid, don't get me wrong. I think he just graduated high school. He's going into college, so he's naive, right? But he asked me a question of like, hey, Ricky, I'm invested in this stock. I'm down like $120. What do you think I should do? And I was like, well, what's your trade plan? He's like, I don't have one. That's your first mistake. He's like, well, what do you think I should do with my trade? I was like, I'm not here to tell you where to buy and where to sell. And if you've been a part of LPP, you know that's exactly what my answer has always been. If you didn't take time to plan out your trade and understand your edge, your entry, your exit, your stop loss, your risk to reward ratio, why'd you even take it? To hope to get lucky? Like, why even sign up for LPP at that point? If you're going to try to hope to get lucky, just continue to trade blind, right? It makes no sense. So the suggestion that I gave was try to fix a problem that a lot of beginners have. And that's, well, you went into this trade and now you're down because you had no entry or exit plan. Now let's change that. So I don't know about this trade, but I just know for your next one what you can do differently, and I think everyone would agree with this, is to give yourself kind of like more of a solid foundation. Plan out your trade, your entry, your exit, your stop loss, understand your risk to reward ratio, making sure that it meets your criteria. So at least at that point, you know exactly what you're getting yourself into, your potential for profit, your exposure to risk, before you actually even take the trade. Why would anyone not do that as a beginner? And this kid got offended. He's like, why don't you just tell me what to do? Why don't you just tell me if I should sell or if, I'm going to be fine? And I'm like, listen, idiot, I can't predict the future. I don't have a crystal ball. And if you can't take time to help yourself, then I can promise you won't last long in this market. And there's nothing wrong with, showing tough love. If you can't put in the effort to figure this out for yourself, what are you asking for help for? If you can't help yourself, no one else is going to help you. I can promise you that. But yeah. No, this kid was not part of LPP. He was just a random kid on Instagram that messaged me, and he said something like, I actually wish I had the messages. It's funny, right? I think people think because I have a social media following that I won't say something back. I don't know if you guys know this. Like, I don't care that much. Like, if you're disrespectful to me in any way, I will be the pettiest person back to you. And I know that if you're part of my LPP team, you know that about me. Because if someone talks crap on someone else, I don't care how much money you make. It's not based off of that. Right? If you're disrespectful to someone for no reason, I think that's something that should not be tolerated, regardless of who you are. And this kid was like, well, I'm not going to sign up for LPP. And I was like, listen, idiot, I didn't ask you to. I was like, I'm telling you, you asked me a question, I'm telling you how you can structure out your next trade to be better off. He's like, yeah, but you're not telling me what to do. And I was like, and even if you were part of LPP, I wouldn't tell you what to do. You don't learn. If every single time I were to be telling you, buy here, sell here, cut losses here, what's the point of that? If you can't figure it out on your own, you really think someone's going to hold your hand along this entire process? No. In a world full of problems, learn to be a problem solver, and you can figure it all out. It's going to take time. You need to be consistent. You need to be patient, but everything You can truly learn everything and anything, and I truly do believe that. If it's learning how to trade in a very minute way as a complete beginner, it comes down to starting your business. Everything it is that I know, it was through trial and error and overcoming challenges as they continue to present themselves, right? Not being perfect, but making mistakes and calculated mistakes along the way. So, all right, we have about 5 minutes left before Jerome Powell begins to go live. Let's see, let me go ahead and get ready to pull it up. Who's ready for JP? Who's ready for Ish? What's the guy's name? The guy with all the rings, all the stones, all the infinity stones.
Thanos?
Yeah, Thanos. Jerome Powell, also known as Thanos. FOMC meeting live. Let's see. Okay. We have 4 minutes left. Is that cool? How many of you guys are part of our Nancy Pelosi trade tracker? It's actually not just Nancy Pelosi, but it's every politician. So every week, every Monday, we send out a free newsletter, and it just shows you in a very visually appealing way the last 5 to 7 trades that were taken by a politician. So if you guys haven't subscribed, it is free. You don't have to. But if you like being kept up to date with what politicians are taking, I'm actually going to be making a video on it pretty soon. And it's going to be about this politician that I'm going to be critiquing her trades. And I think some of you guys might enjoy it. So, but yeah, you guys can subscribe to our free trade tracker. It's the first link in the description down below. If you don't see it, refresh it. First link in the description, just fill out your info and you'll receive a newsletter every single Monday. Just one a week as of right now is what we have scheduled. All right, 3 minutes left. Market's pretty flat, right? Wouldn't you guys say? Market's pretty flat. Market's green, obviously, because it opened like this, but there's been lack of progress for the better half of the day. Okay, 2 minutes left. Where are we at right now? Yeah, if it's not too much to ask, if you guys can drop a thumbs up and subscribe to the channel, of course, we'd greatly appreciate it. And I'd love to keep you guys up to date with everything stock market related. So we'll see if we can get to 750 likes. Just half of you. Just boop. Quick, simple, easy. Ricky, have you seen the new ZR1? Why do you think I said it? Why do you think I used that as my analogy? I don't know if you were here earlier, but yeah, I'm not a big Corvette guy, obviously, right? After my accident. But I've never been in all of them. I've liked them. I feel like they're sexy looking cars. That ZR1, 1,064 horsepower. That's dope. The front end of that hood, that huge spoiler, how wide it is, I wouldn't mind checking one out. I'm just saying, if any of you guys work for Chevy and you're based out of Arizona, I'm not saying that I would buy one. I'm not saying that I won't. But if the numbers make sense, like we said, I would consider it. All right, let's pull it up. Enough yapping. You guys need to tell me. Ricky Yap Central. going to make myself a little bit smaller, okay? There it goes, JP. I hope you guys enjoy, especially for those that are tuning in for the first time. Drop a thumbs up, subscribe, and if you have any questions after, send me a direct message via Discord or via Instagram, and that's going to be all linked down below. Here we go, the man of the hour, Thanos. Ooh.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina.
Go.
Gina Smilek from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Good question.
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Wow, that's good.
So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Is this good? Having the split screen?
Howard.
NASDAQ, Jerome Powell.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting.
Wow.
If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that,
unemployment.
specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. we just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those 2 things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those 2 things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. Yeah. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut, or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market, and, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi,
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're under-reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note.
NASDAQ market beginning to show signs of resistance. It's quite overbought. Just a quick little heads up for all of those that are actively trading right now. I have no active trade when it comes down to this.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence, Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports in the last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going.
So I don't know if you guys understand that question that he's asking, but pretty much the job reports and inflation, the inflation reports are a really big focus for the Federal Reserve. This guy was pretty much asking us like, you're paying attention to the unemployment rate, but the unemployment rate can be somewhat manipulated based off of private sectors. In this example, he was given with the government. The government's doing a lot of hiring, so it shows job growth, but it's government-based job growth. So again, could the idea of this like unemployment rate that we have actually be different than what it actually is if it wasn't for these private sectors that are influencing that unemployment rate? Hope that makes sense.
About this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, even...
Okay, I want to quickly wrap up because we have about 1 hour left until the market closes, and then Meta is going to be reporting earnings after the market closes. So I'll leave it up to you guys. I definitely do not have to. I was thinking of hosting the Meta earning report live stream, so I'll be going live about 5 to 10 minutes before. Right now we're about 750 likes. If this video gets over 1,200 likes, I'll host a free live session in about 45 minutes so we can watch the market together reacting to Meta earnings. Again, I'll leave it up to you guys. Drop a thumbs up if you guys want me to do it. Make sure you subscribe. If not, no hard feelings. I'll just see you tomorrow at Market Open for our live trading session if you're part of our LPP team. And again, if you're ready to join to be able to watch me trade live every day, it's going to be that second link in the description down below. And for all those that have been messaging me, yes, prices are going to be going up for LPP 3.0 once it actually comes out in September. So if you do sign up now for 2.0, you will automatically get access to 3.0 at no additional charge. Right now it's a one-time payment, lifetime access, and you get it for 50% off. Don't feel rushed to sign up. I'm just making you aware that within a month, it's going to be twice the price. And again, the setup is going to be a little bit different. So if you are interested in watching me trade live every day, you can feel free to sign up right now. And that's that second link in the description down below. And don't forget to sign up for our free trade tracker. And that's that first link in the description down below. Like always, let's make sure that